Good morning, insiders. Now, I logged into my ThinkorSwim platform this morning, and I don't know if you guys ever had the thought of, man, I've been holding this ticker for a while. I wish it was paying me dividends, but obviously it's a growth stock, not a value stock, so it doesn't pay any dividends. But there is actually a way to make your favorite companies pay you dividends. And in this video, I'm going to show you exactly how, because I was about to do it this morning and I figured, hey, I might as well make a video on this because this is a great way to actually make real passive income. So let's go ahead and see what tickers I have. I have Tesla and I have Coin. I have a little bit of PayPal. I have 1 share in PayPal. I just had a little alert order go out. Now you can only do this on companies that you have over 100 shares with. So on Tesla, I won't be able to do this unless I buy 30 more shares. But on Coin, I have 110 shares. So this is a perfect candidate. Some of you probably already realized that this strategy is called selling covered calls. So in this video, I'm going to quickly show you how I find and pick and execute my favorite covered call with potentially the highest premium and the lowest downside risk. And I'll share some tips and tricks along the way. First of all, let's go to Coin and see what it's up to. So it's on a nice little front side move, and typically you want to be selling covered calls in a bullish or ranging market. You don't want to do it on a downwards trending market, although you can, but the premiums are going to be less and your underlying asset is depreciating in value. So it might actually just be better to sell the underlying asset, but that's a different discussion altogether. Right now, Coin is definitely on a front side move. We had earnings come out, they look good. We should be continuing this front side move over 300 and maybe having a double top at one point near former shoulder, maybe something around 350 or so. So that is a really good place to look for a potential move. And I think that would be very risk averse. There's 2 types of risk when it comes to selling covered calls. The first one is the price goes much higher than the strike price or the exercise price of the call that I sold, which means I'm going to miss out on that upside because I'm going to have to sell the stock at a lower price to whoever bought the option, the right to buy my stocks at a certain price. This risk I usually mitigate by just making an absurdly high strike price that typically never gets reached. And if it did get reached, I would probably blunder my exit anyway, so I don't really care. The second risk is basically that the stock goes down and my principal goes lower, which would happen anyway. And that's why I like selling covered calls. Now, one thing I'm not a super big fan of is the volatility is relatively low right now. You can see with the volume, or I would say it's like maybe right perfectly in the middle. You get a lot more premiums when the volatility is higher, but I like to sell calls every month, so it all kind of evens out in the end. Let's zoom out a little bit and find a price that we would be happy selling at anyway. So just in case we do get exercise, it's not a big deal. I would say somewhere around 300 to 350. Anything in this area to me is a total sell territory because of that former shoulder. So I'll just make a little bit of a note here and we can make this red just to keep that in mind. So I bought recently here, and if it goes up here where there's this huge shoulder and a lot of supply, which is resistance, I would be happy to sell anyway. Now, if it doesn't get up there and we sell these covered calls, we collect that premium and we would have been holding anyway. So let's go to the trade tab. Here's my active trader. You can see my position on Coin. I have 110 shares at 227. Now let's go to all products where you can find the option chains. We'll hide this, we'll hide this, and maybe move this down a little bit. Now what I like to do is do every month, I like to sell covered calls if I can. So I'm gonna go out 1, 2, 3, 4 weeks, open this one, and here are all the strike prices. Right now it's only showing 14. We were talking about looking into the 300s to 350. So let me just show all. And here, let's go further down. Here is 300 to 350 in this area. And we're gonna be doing calls. We're gonna sell covered calls. So let's go back down to 300 and look for some good premiums. So here we can sell 1 contract and make 530 on that contract, but contracts have 100 shares, so that's why we need 100 shares. So it's 5 times 100, so we would be making $530 if we sold this one. You could see it down here if I go and make one contract, I can say confirm and send, and you'll see I would make right now $530. Max loss is in theory infinite, because if the stock goes to $1,000, I would still have to sell at the strike price of $300. So that means I got to cover $700 worth per share. So that's why it's an infinite amount, but I would never in theory lose money because I'm selling covered calls. I own these shares, so I'm never going to have to fork up money I don't have. So in that regard, selling covered calls is considered a very conservative strategy. Now, I think 300 is maybe a little bit too aggressive. I would like to sell at maybe closer to like 330 or 350. But at 350, you can see that premium really disappear. So I wouldn't be making more than $69 on this one, which, hey, no one ever complains about making a quick $69. This is basically the easiest risk-free $69 you will probably ever make. So let's find a happy medium. Well, we have 530. But if we go down somewhere here, you'll see at 325, it drops significantly, but then it goes up again, which is very unusual. I don't see this a lot. So I actually kind of like the fact that I get a better strike price and I make more premium. So let's go ahead and select this one, sell one share. I'm going to actually select good till cancel, click confirm and send. And here you can see I would make $285 right now. There are some fees involved. It would cost me 50 cents roughly, and that is from TD Ameritrade. Charles Schwab is actually going to be very similar. I think it's like 5 cents less, and then there's a regulatory fee which is 1 cent. So I pay 51 cents for this, and that is per contract. So if there was 2 contracts, I would be paying $1.02. Let's go ahead and send this order off. Here you can see my sell order now at the 285 premium at the 330 strike price. So what I like to do now is go to active trader, and I like to pull up this exact contract and see the chart here. So this chart used to have a premium of $15.75. Imagine we sold that, but we would have had to go much further out in time. So that's also an option. Maybe selling 2 months out, you get much more premium, but the chance of your strike getting executed might be higher. There's a lot of ways to play this game, and I'd be happy to make a follow-up video explaining more of those. Actually, I interviewed 2 people in our community who focus on selling covered calls for passive income. They gave great insights on the best time periods to buy and sell covered calls, and they also gave some additional strategies like rolling over your covered calls to extend your time frame. That's a slightly more advanced strategy, really nicely covered in this podcast interview, so I'll link it in this video if you're curious. Here's the chart, and you can see that actually just yesterday this had a premium up to 330, so we could make $330 just by selling this one. I'll leave my limit order here for now, and I'll check it at the market open. Remember, you cannot sell options pre-market or extended hours. Also, it looks like the liquidity here is fairly low, so it might take a while for my option to actually be executed. Here you can see my order on the ladder. So if I get filled, I'm going to make $285 right away. My real max opportunity cost, since the strike price is at 330, is anything over 330, I would miss out on the upside. And that's about $200 to $300 per percent, which I'm fine missing out on because I probably wouldn't nail the exit anyway, and the chance of it happening in the next 4 weeks are pretty slim on top of that. Also, that's exactly where I want to sell it. So in a way, I'm actually being paid to sell the stock I was going to sell anyway. In my experience of selling covered calls, it's actually really rare to get exercised as long as you have these higher strike prices. And I always like to look for these former support and resistance zones, because even if the price does go to 350, it'll probably end up consolidating in this area for a few weeks before it actually breaks out at 350. In which time, 4 weeks will go by, my options contract will totally disappear, I collect the premium, and I just do it again. 2 things to note: the higher the volatility, typically the higher the premiums. The higher the price near your stock price, the higher the premiums. Right now, the stock price is at 228, and if we go back to the option chain, you'll see that this is in the money and this is out of the money because the strike price is below the current price of the stock, and here, out of the money, the strike price is above the price of a current stock. So these options, I would collect less premiums because it's less likely to reach these prices. That's why options chains also give you a good view of inside the market of where people think the price is going to be at a certain time period. I hope you guys enjoyed and learned something. Thanks for tuning in and dropping that like. I'll see you next time.